Welcome back, ladies and gentlemen, and get ready for the next very interesting session, which is on emerging fintech markets for 2021. Let me go ahead and introduce the moderator. This is going to be a panel discussion. So, our moderator is Suresh Raju. Thank you, sir. And let me now go ahead and introduce our panelist for the same, Sunny Banerjee, MD, Fidelity National Information Services. Welcome to you, sir. And of course, we've got Vikas Shah, MD Fintech, Capital Raising, Rosenblatt Securities. Well, welcome, gentlemen. And quickly, I'm going to hand over the session to Suresh Raju.
Thank you, Dhwani. Welcome everyone to the session. Topic for our session is emerging fintech markets for 2021. And good evening, good afternoon, and good morning to everyone, the global audience here. Welcome to TGS 2020. First of all, thank you to Sunny Banerjee and Vikas Shah for taking time to participate in our discussion today. Welcome to both of you. And let me just quickly introduce Sunny and Vikas. Sunny, as we just said, is the Managing Director at Fidelity National Information Services. He's based out of Dallas. Prior to his role at FIS, he's been the Managing Partner for the Management Consulting Practice of KPMG. His expertise is in the area of digital and customer experience strategy formulation and implementation. Sunny started in banking and is an active angel investor. Vikas Shah from Rosenblatt is the fintech investment banker, and he's got 2 decades of experience in financial services, and he's the institutional investors recently ranked him as fintech finance 40 list for second year in a row. Congrats, Vikas. And Vikas is previously worked with Credit Suisse and Director of Principal Strategic Investments with AIG, so brings a ton of experience in the financial services world. Again, welcome to both of you. Uh, just a quick background from my side. I've been in the financial services industry for over 20 years and recently focused on the asset management part of the financial services. We have recently launched an online portal, 72pi.ai, a gateway to creating your own fund for retail consumers, right? So very excited about that. With that, before we start the session, I just wanted to give a quick disclaimer, uh, just to make sure that we're all on the same page. All views presented here are represented here by the individuals, and they're not of the companies that they're part of. And any investment related questions that we're dealing with are meant from an industry investment trends perspective and are not reflective of the businesses that Sunny and Vikas belong to. Yeah. With that, we'll get started. What I'll do is I'll give a quick background of the fintech landscape for a minute or so, and then we'll hand it over to Sunny first for his opening remarks, and then to Vikas. As you all know, fintech is a very large industry now, and it is one of the hot spaces within the venture capital investments arena. It has attracted about 20 billion or so investments in US alone. And if you just look at all the investments, VC and other investments, it is about $60 billion last year. Very large market. Even through COVID, in the first half of 2020, India had seen about $2 billion of investment into fintech startups. So there is a lot of activity here. Some say fintech is white hot, some say it's red hot. So we'll talk about the areas of investment that are interesting. What are the opportunities for entrepreneurs to consider within fintech? Some of the trends that you're broadly seeing in fintech is it's almost like an on-demand finance now, right? It's becoming a reality thanks to mobile and cloud computing. And we all know some of the larger examples like Marcus by Goldman Sachs providing no fee personal loans, high yield savings for individuals, kind of democratizing the process of bringing institutional products to individuals, right? We also see Chime, a San Francisco company, which is providing banking with no hidden fees and free overdraft. So all of these are transformational, and it's changing the landscape of fintech. And some pundits say we are just at the beginning of this, right? Fintech is only 1% finished, is an article that I just read. So there is an ocean of opportunity out there. So with that, there are several sub-markets within fintech. Vikas and Sunny and I will try and see if we can go deeper into some of these areas. With that, Sunny, over to you for some opening remarks.
Thank you, Suresh, and great to be on the panel today. And I'm looking forward to a great discussion with you and Vikas. And of course, glad to be part of TIE. I've always enjoyed being part and member, a charter member, and board member of TIE Dallas. So it's a pleasure to be on with this panel. With that, I think the way we were discussing is if you look at the retail banking space, there's been a lot of focus and investment and growth, and the hype has been around the whole payment space. And you have looked at whether it's the Tencents of the world or the WeChats of the world or Square or Stripe, the valuations have been amazing, and the growth and innovation that they've created in that space has been very, very effective. So we will have a discussion around that payments bucket, if you may. We will touch on what you also did with the Chime example and the Marcus and others. We will talk about some of the business model opportunities that clearly exist in this retail banking space and driven by technology, driven by the innovation of these new companies. But there's also possibilities that we think is possible if you rethink how banking gets done, how some of the key uh, enablers within banking, whether it's mortgage, commercial lending, how we feel there's still a massive opportunity in that space. And then we will focus on customer experience and efficiency. If you look at the North American market, you have some banks who are at an efficiency ratio of about 50%, and there are some still stuck at about 70. Now, any business, right, if you have a 20% gap, clearly is there a fintech or a set of fintechs and things that can go after to make the banks who are at that 70% get to 50%? Or you can go after the business in a way to take advantage of those inefficiencies. So that's another bucket, if you may. Last but not the least is what we have seen as the massive change in customer experience and how customers are interacting. And I think COVID has accelerated that process, right? We are all virtual, we are all digital. The transactions are happening in a completely digital environment. And with that, it brings up very interesting aspects of how are customers going to interact in banking and financial services space, given their experiences, whether it's in grocery, how they're watching movies, right? How they're traveling or not traveling, and how all of that has changed their expectations, and how should banks reflect that in the customer experience. So we'll touch on things like, embedded finance, and Vikas has some really good ideas in that space that I'm sure he'll also share. And last but not the least, in order to make all of this happen, how will the infrastructure evolve and change, right? And how will cloud and big data and the robotics part of it and impacting process? So a lot of things happening. And as we delve into these, we find still, as you said, Suresh, massive opportunities in the fintech space in each of these four buckets. So payments, challenger banks, targeting efficiency ratio, and then customer experience around loyalty and rewards, et cetera. So that's kind of my say. I'd like then hand it over to Vikas to segue into his pitch, and then we can have an open conversation.
Sure. Thank you. Thank you, Sunny. Nicely put it. I think nicely grouped into four groups. Let's go through each one of them after Vikas has his opening remarks. On to you, Vikas.
Thank you, Suresh and Sunny. Looking forward to a vibrant discussion. Thank you, Ty, for hosting us and giving us the opportunity to share some of our thoughts. What I'm going to do is I'm going to share some slides, if you don't mind. So it, gives frames the conversation more effectively from us. So give me 1 second, and I'll get this thing going.
Please go ahead, Vikas.
Okay, so I'm presume that you can see the slides, correct?
Not yet, Vikas.
Okay, 1 second, hold on. Okay, now can you see the slides?
Yes.
Yeah.
Okay.
Yeah. Terrific. So in terms of trends, and Sunny alluded to a couple of these things already, so I will just kind of emphasize further on what he alluded to and build up on it. The two trends that I'd like to really talk about are trends where fintechs having really starting up on the low risk to no risk agency businesses to actually migrating to a much more of a risk bearing business where they themselves potentially become a bank themselves, a challenger bank with their own balance sheet rather than necessarily building on a balance sheet of a third party bank partner or an insurance company actually taking risk on its own balance sheet kind of thing. So that's the first trend. Here the VCs in the Silicon Valley started with businesses that were really lower risk asset light businesses. They had lower barriers to entry because they could use technology to really automate some of the aggregation process that were not done as effectively before. The last part is that some of these businesses compared to a full-blown brick and mortar businesses had lower cost of acquisition. So that model was very appealing to the Silicon Valley investors when they first started funding some of these businesses. However, over time, what we have seen is number of these businesses, whether it's Square, Revolut, Borrow Money, on the banking side, or Lemonade and Oscar on the insurance side, what they are seeing is they want to have more control over their own full stack model that they want to provide. They want to have better user experience. They want to have on-demand products that they want to build. And that is where they are seeing the benefit of actually having a full stack insurance or full stack offering and being a licensed entity that also increases their stability and perception of stability from their users. And the last is that also opens up a much larger total addressable market TAM for each of these businesses. One fantastic case study is really what Square has done in the space. Square started with really providing simple thing like a Square POS, which is their, you could swipe through credit cards. So a small taco truck owner can actually accept credit cards and not have fuss about expensive terminals and stuff like that. They use that essentially as a customer acquisition tool. And they have done a similar thing on the consumer side using a Square Cash App, similar to a Venmo or a PayPal or things like that, which is like a P2P payment service. So Square is one of the first companies that has actually attacked the payment models from both sides, the consumer end as well as the merchant end, and has built a very powerful ecosystem that has allowed them to collect and aggregate data in real time that becomes foundation for offering a much more lucrative products such as loans, such as investments, insurance. And if you see what they've done with Square Capital, that's really the full-blown entry into providing full-scale financial products into it. And that's where you are seeing them setting up as non-bank financial services companies to now becoming a full stack licensed bank and becoming taking advantage of owning the full the technology stack kind of thing. One chart that is really stunning to us is what it took for JP Morgan 30 years and 5 acquisitions to amass 60 million customers. Square and PayPal have amassed those customers in a matter of 5 to 7 years. This is a staggering chart if you can kind of think what they are able to do with it. And it is something worth, we will explore this, the benefits of some of these customer acquisitions and what you can do with it, which actually brings me to the second trend, which is some of these companies have started disintermediating banks. And that disintermediation is happening at every level, whether fintech or tech. And if you see how customers were serviced before, they were individual silos were selling them. A retail bank would sell them checking accounts. A securities sub would sell them a brokerage account or a lending account or things like that. However, with all of the technologies that are coming up now, the companies are looking to own the customer first and really then figuring out what all services can be sold to those customers using high quality technologies like creating persona of a customer and then following the life cycle of the customer. So
So,
that is something, yeah,
so
go ahead.
because what has been bundled together by the banks is now getting unbundled, right? It's getting.
Is getting unbundled and then eventually rebundled once again, believe it or not.
Yes.
So if you're saying the journey, this is the journey where it became unbundled, where with some of these things where individuals were going after only checking accounts or only lending or things like that. But now if you see the Facebook, the Amazon, and a number of those, Ant Financial is a fantastic example out of Asia, that is really owning the customer and then giving you everything, all of the products to their platform. So at the end of the day, where the risks for the banks lie is really they are not disintermediating, mediated between them and the customers, right? The customer relationship is owned by the technology company more than the banks directly. And that's one of the things what we call the rise of tech fin rather than fintech. So the tech is leading the financial aspect of it more than the fin side of it, right? And this is just an example of Stripe Treasury. Stripe just came up with a product, announced a product only a week ago called Stripe Treasury that embeds, provides banking as a solution to their clients. So Shopify, which is a client of Stripe, can now offer all of the banking services directly to Shopify customers. And the backend in many of these things are provided by some of the brand names like Goldman and Citi and Barclays. So we are now seeing how Stripe is actually disintermediating the banks from customers like Shopify that otherwise could have gone to the bank directly, kind of thing. So those are the two things I wanted to talk about. One, business models migrating towards more risk-bearing models, and two, some of them coming in and owning the customers where they are disintermediating the banks.
Thank you very because very helpful, very insightful. So I'll now add a couple of points in the market that I'm in the whole wealth tech. See, what we are seeing is, everybody wants self. Wealth management is a large industry, but it's serving the ultra rich or the HNIs or people who have $1 million or more. So the average person who wants to kind of build his wealth is not getting the service. So self-service in wealth management is in high demand. Along with the digital aspect of it, it's making it more affordable for everyone and more reachable to everything. So our business also, the 72pi.ai, is kind of in that space. But broadly speaking, in the whole wealth tech area, robo advisors, retirement services, micro investment, right? I can't afford to buy an Amazon share, but I want to invest $100 in an Amazon share, right? The whole concept of micro investment and digital,
Fractionalized shares.
yeah, fractional
Yeah.
shares and digital brokers and investment tools and portfolio management, all of these different spaces in the broader wealth technology space are also getting, re-innovated or innovated because of AI and big data, right? All of these drivers of data and cloud are kind of making it more accessible for everyone. With that, I would like to come back to you, Sunny, on some of the points that you had said. And from the perspective of people in our audience who are kind of more entrepreneurial, looking for new areas, looking for changes in the business model, love to kind of dig a little bit deeper into the two areas, the customer experience and efficiency, and maybe touch a little bit on payments and challenger banks, because I know there has been a lot of stuff written on payments and challenger banks, but love to hear your deeper thoughts on how loyalty and rewards and efficiency is creating new opportunities.
Sure, sure. Thank you, Suresh. Great points by you and Vikas. I think maybe one of the ways we try to think about these opportunities is we look at particular ecosystems that have a lot of friction, a lot of wastage, and a lot of inefficiencies in the entire ecosystem. And then we apply and say, okay, is there a way to take away and create value within those for the end customer? So one example might be in the efficiency area is to look at the whole mortgage ecosystem, which would be made up of like lenders, realtors, right, consumers. And one of the companies that we like, but it is just one company, it's called Qualia, Qualia. And it's a very interesting company basically what they have done is what Vikas and you were talking about in terms of leveraging data in a shared space.
Yeah.
And so they have mapped the needs of all of these stakeholders that I just mentioned, right? From a lending perspective, realtors, title insurance, and the consumers. And they have created a virtual digital experience end to end with the whole premise that as a consumer, I can get my mortgage signed without ever leaving my house. They've even launched like a remote online notarization where they've incorporated as part of the platform a very digitized manner of authenticating the documents you're signing, for example, authenticating the person, authenticating the notarized individuals, and creating an end-to-end experience that is very secure and validated and protected from fraud, because that would be one of the key aspects, right? And then what they've also done today, this is being done across multiple applications, multiple organizations. They're bringing all the stakeholders onto a single shared platform and allowing the entire process to be managed and communicated in real time to all of the stakeholders. So every time everyone knows where the item is, but most importantly, they're taking out massive amounts of handle and interchange between individuals. So just an example of how the mortgage value chain, if you may, right? If you think of it from a supply chain perspective,
Yeah.
and if you have chevrons, how can you go after and create? And each of these, like you could look at title insurance, and that by itself is a multi billion-dollar market that still embraces in many aspects very traditional paper-driven ways of interaction. The whole closing process, the appraisal of the home, for example. Why do we still need a person to come in and appraise a home?
Yeah.
Zillow has done some wonderful things there, right? But it's not mainstream yet. So why are we and one just comment, and I know you're dying to ask me a question or interject, but no, I'm just saying, one of the things that we observe in the last with the huge surge given low interest rates is the appraisal cycle has a 4 to 6 month lag depending on which geography you're here in the North American market. And it befuddles me that somebody's not stepping in and automating that entire process as much as possible, which so that it can still be used for underwriting purposes. But these are the kind of opportunities that I think will address that 70 to 50% gap that we talked about in the efficiency ratio, but also for entrepreneurs looking for ideas to go after, this would be a really good place to focus on.
Can I ask a follow-up question on that, Sunny? I think you touched on the entire value chain of insurance and insurance technologies, right? So I think before we got onto the live session here, we were talking about Tesla, and is Tesla the right guy to give you the best insurance product? Is it a pure play insurance company? Is it a fintech company coming to disrupt? Is it the bank that is funding the car purchase? Who is best equipped to do that? Love to hear both of your thoughts, because Tesla has got the data, right? The point that I'm trying to make is, on one hand, you're a product-centric model, then it became a customer-centric model. Now, if Tesla is going to give you the best insurance, that's a data-centric model, right? Where is the world going? Where is the opportunity? You can use that as an example, or anything else that you experience, Sunny and Vikas, to kind of give where the disruption is coming in the value chain. And this may be applicable to mortgage tech, insurance tech, and all the other kinds of financial products, right? On to you, Vikas. What do you think?
Yeah, thanks. I think we are absolutely fascinated by, and we study this quite carefully as to how the risks are shifting. And with the advent of technology, the risks are shifting rapidly. So you brought up the example of automated cars. So think about how insurance is generally priced. Insurance is priced per driver. Who's driving the car? What kind of car? How old? This, that, all the different things that we generally know. But when you put that in the context of automated cars, self-driving cars, the driver is not is not the part that is causing the risk. It's the car itself that might misread the environment and actually get into an accident. So who bears the risk? So it is natural that the risk is going to shift from a driver to the manufacturer of the car. And that's just natural. Now, the question is whether manufacturers themselves are able, want to create insurance products, or do they want to partner with third-party insurance companies to underwrite those risks and stuff like that? Either way, the the risk has shifted, and we've got to really understand that risk and who bears the risk. And so, if Tesla is naturally, the one that has the underlying data on the engineering side, on the performance side, on the potential risk side, and what worked and what didn't work, it is natural for them to either create the underwriting capabilities themselves and capture a potential market that is vast above and beyond what just selling the car. Now you're getting into a completely different pool of revenue pool. So if from our standpoint, very quickly, you're going to see companies actually becoming de facto embedding financial services and insurance into their own product. And that's what we call embedded finance. And we are going to see that trend pick up rapidly across the spectrum in all kinds of non-financial services businesses that is going to embed financial services products and services inside of their own core offering.
Great point. Like that a lot, because any comments on that, Sunny? What are you saying? Do you agree, or do you see a different trend, or is this where we're going? The product manufacturer.
I think that's a great idea. I think some of the things I think the industry will think through, right, is the legislation has to keep track of how risk gets migrated from the way it's valued today to the laws have to keep pace with it. I think the other part of it is the critical mass, as we know, right, in a pool of insurance, risk has to be built up and shared. So I think there's going to be a little bit of chicken and egg, but overall, I think the embed finance thing is something I take away. Like, just to add to that, beyond the insurance, if you really think about it, why do we even need to take out a card when we fill up gas? There should be the credit card and the authentication should be built into it. When you drive into a drive-through in a fast food restaurant, shouldn't it be all authentic? I mean, why do we even need a phone? It should be now available with the amount of computer horsepower we have in cars. So I think you're absolutely right. I mean, the embedded finance angle is going to take more and more, and we're going to see. But the challenge that banks need to really think about it quickly is what Vikas and you just talked about is further disintermediation of banks and insurance companies moving away from the customer, because we are going to see a very aggressive change by highly innovative, extremely nimble providers who see the opportunity, and they will tackle this in very different ways, creating very high customer satisfaction at the other end, right? So I think it's a really good point. If I could, Suresh, just touch on one other thing, which Vikas, I think, laid the foundation for, which is the data platform.
Yeah.
You know, the part what Amazon has done on the lending side, right? Which is because they have all of this information, which is the same thread. If you have all of this information about your consumer, there's so many things you can offer, not like an offer that says you're 90% approved and the 10% will be approved when you put in the application, but a firm offer saying, here's $100,000 because I know everything about your business for the last 4 years, right? And so I think the market is moving there, and I'm kind of going to challenge all of the large institutions out there to really think hard of how can you make your processes and understanding much more nimble so you can attack that before the Ants and the Alibabas and the Amazons. American Express is the only other person that I've seen do it really well using the tremendous amount of data that is out there by building small business loans. But I digress a little bit, Suresh, and because
No problem. Interesting point, Sunny. I just want to touch a little bit on the next aspect of it. We talked a little bit about the risk side, who owns the risk, how the risk models are changing, how the business models are evolving. I think the other aspect, obviously, we touched a little bit on the regulatory side as well. The third dimension to fintech, to some extent, is cybersecurity and fraud, right? So as things evolve, as data is collected, is IoT kind of helping you do the data acquisition, and AI is kind of helping you do the insights on the data. Then the question comes, and as I said on wealth tech, and what we are seeing is a lot of self-service, right? Why don't I do it myself? How do I do it? Do it yourself investor and so on. In that play, how does cybersecurity and fraud evolve, right? So I think, Sunny, you had talked a a little bit or touched upon it when we were discussing on synthetic fraud. Love to hear from you, and then we'll give it back to Vikas for his comments.
Sure, sure. I mean, no, you're so right. I mean, as especially again, I keep bringing up and we keep bringing it up, right? The COVID has kind of morphed the human interaction, right? And what it has also done is not only are people interacting in a virtual environment, it has increased the number of people who are in the fraud side of the business. So the bad actors are also not a 9 to 5 bad actors; they're like 24/7 bad actors, and that has created a big fraud issue. So if you look at, I mean, a synthetic ID, right? I think most people get it. You take like a social security number, which is real, and then you marry it with a different name, a different picture, and you created a synthetic person with one critical piece of element of information that is solid and works in the system. And now that synthetic person can go out and take credit cards, loans, deposits, and builds up that synthetic credit card. So that's a serious challenge. And it's not one or two, it's happening in the millions, right? The other part, Sudesh, that is also happening is in the authentication space. So creating of deep fakes, taking over your device, even if you feel you're biometric secure, and taking it over before it communicates and taking direct communication with the APIs, for example. And so now the fraudster has taken it over and they're communicating directly to the APIs. And so you might feel very secure, but it's not your information that is going across, but it's the other. And so just one thought of what organizations and innovative fintech companies are doing is they're mashing up localized data. So if you, Suresh, are dialing in and showing your picture, and if the device has a picture that is showing you're from Hyderabad and it's showing the weather, that is being mashed up by some innovative security fintech companies to protect and authenticate that you are indeed. So if the fraudster doesn't know that you are today in Hyderabad and that's where the weather is of what it is, that nanosecond validation is happening while you're being accessed. So, I mean, just as they're doing things, there are fintech companies coming up with interesting ideas, but I'm glad you raised this because I see the fraud cybersecurity space as a massive area of innovation and continuous innovation that entrepreneurs looking for growth ideas and opportunities should definitely look at, because it's not going to go away in the short run.
Any thoughts, Vikas?
Yeah, I think this is as red hot or as white hot as you want to talk about as it can get. If you believe that the next, many decades to come, the growth is going to be on the digital side. Side of that is the security aspect, which is what you just alluded to earlier. How can you not have a secure system? Because that creates the core value of trust. Otherwise, nobody's going to transact on your platforms. We have personally at Rosenblatt funded the 3 or 4 companies in the last 12 months or so that are really along the identity management, fraud detection, detection of things not only on transaction basis, but also in communication. So people on the email side and chat side and the phone call side where fraudsters might be. So there's one company we were working with and got funded called Digital Reasoning, and we sold recently it was a trade sale recently. And the other company called Deep Labs, which is really using persona-based identity validation, which they are going to collect, probably 100 data pieces along different points about the person who's requesting it and kind of validate if all those things are consistent with what the request is, and reject and things that are not consistent. So there are lots of these kinds of things that there's a big issue about account takeover, which is what Sunny was referring to about deepfakes and stuff like that. Once they take over accounts, they can do a lot of damage. So the question is, can you, the damage, the cost of that damage is multifold if you catch it only after the fact versus if you are able to catch it before the fact. So there are companies that are doing lots of work in interesting areas like that, that are solving puzzles of all sorts in identity management and fraud detection. So customer onboarding is another big area of focus. for banks. And we are seeing lots of companies
KYC and
doing
onboarding.
it.
Yeah. So the elephant in the room for fintech, right? Obviously, cryptocurrency and blockchain, and post-COVID, blockchain is trading at all-time high prices, and it's going up every day and a little bit more volatile than the other markets, but definitely a lot of investors are looking at it. I know I don't want to ask generic questions, but what do you think of cryptocurrency, blockchain innovations? And these are now getting into use cases which are tied up to businesses. And as we talked about embedded finance, are we looking at embedded blockchain innovations coming and disrupting businesses from behind? Is that where we are headed? And any thoughts that you have? That'll be great, Sunny, to start with you. I know it's a
Sure.
hot topic. Sorry about that.
And yeah, and I'll stay away from the valuation angle because I think it has been a crazy valuation especially over the last couple of months, right?
Yeah.
What I find attractive is the whole design principles that are there in the blockchain design and technology. And in terms of anytime you talk about fraud, you also have to talk in parallel about authentication of the document, of the person, of the transaction. And that's where I find it when we are talking about leveraging, again, the ecosystem opportunity, and we are talking about, say, even in the mortgage, right? If you can really authenticate the ownership of a property, which still today is not possible in major countries of the world. It's amazing when you look at the title insurance and the title of a property, is it belonging to Mr. X, right? And that authentication, when you make it available globally, that can be fascinating. Even at the very basic level, Suresh, if you think about a person who says, I have my MBA from degree X and I have my bachelor's from university Y, right? Being able to authenticate it for 80% of, say, the human race, and knowing that every resume that is being presented is authentic without having to run another massive check. I mean, those are the kind of game-changing opportunities that are out there that I think can be done on that technology. So that's what I find attractive is take these massive opportunities and pain points and fraud and that is there that we know and solve it using this technology. I'll let Vikas address the other more complex task of valuation and aspects of it. I think that's more of it in his vein. But that would be how I would like us to think about Suresh and from a blockchain
So
perspective.
if Vikas gives us permission, we'll buy Bitcoin at these prices tomorrow. To buy.
So I will stay away from speculating about the pricing of Bitcoins and stuff like that. But look, there are two aspects of it, right? And there is the blockchain aspect, core blockchain aspect of it. And then there is the cryptocurrency aspect of it, which is the store of value and the Bitcoin or Ethereum or whatever that coin you want to talk about. The blockchain aspect is the core, it's just a protocol. You can build lots of different applications. And we are seeing proliferation of companies offering all sorts of applications. There are some incredibly interesting applications and really creates transparency, which in turn creates liquidity into assets classes that were never transparent and liquid. And that brings down the frictional cost, the cost of transacting when you have transparency and liquidity. So we see this, for example, a company called Figure. Figure is a company started by the original founder of SoFi, Mike Cagney. And Mike has launched this called Figure, which he does not market his company as a blockchain company, but on the back end, it's entirely blockchain enabled architecture. What it does is he's giving you HELOCs, home equity line of credits, which is like a very easy to understand asset class for everybody. But that asset class has a massive asset class, but has lots of inefficiencies. What he's done is he's used the power of blockchain to create some of the authentication, validation, and putting trust into it, which is kind of what Sunny was referring to in a mortgage process. Essentially, he's created that on the back end and created easier to trade assets, mortgage assets or HELOC assets. If you take out frictional costs in these markets, you're talking billions of dollars of savings, billions of dollars. There's another company called Exoni that is doing the same thing in equity swaps in capital markets, or repos in capital markets and stuff like that. So there are lots of companies that are actually harnessing the power of blockchain and the cryptography that comes with it, the ledgering capability that comes with it, the atomic swap exchange that comes with it in an instant kind of thing. And the applications can be infinite, from payments to capital markets to, you name in real estate financings and stuff like that. The other aspect of it, which is crypto side of it, and we can all debate till cows come home about what is the fair value of crypto and stuff like that, and whether this is a fad and going to go away and it's going to come down crashing, or whether it's going to go to 300,000. That's kind of what the the founder of Galaxy Capital just said, that crypto is going to touch 300,000 kind of thing. The point there is not so much what the valuation is. I think the lot more interesting point is it something that can create a currency that becomes a currency, an asset that you can own in lieu of something like a gold or things like that, and help you against devaluation of certain currencies, whether it's US because you think US is accumulating too much debt, or Europe because Europe is in a funk and will never recover kind of thing. It gives you a hedge against currency devaluation and things like that. So there are lots of use cases to it. We think this phenomenon of blockchain particularly is much broader than just finance. It is we are seeing applications into all sorts of things, other areas in medicine, in aviation, in all sorts of things we've seen applications on. So very, very vibrant thing. I am very bullish on it as applications, but it's something that is going to evolve over time, over the next 5-7 years.
Thank you. I
And
think,
Suresh, can I just tag on to that? Like,
yeah, please.
if you think of profound impacts, I mean, again, just holding on to this because mortgage is easy to understand. And can we not close a loan in like 3 or 4 days? Why does it take us as long as it does? Imagine if a new company came in and leveraged all of the little things that we are talking about in an end-to-end process. I would argue that the end product would be more secure, more authenticated, and to Vikas's point, the value that you're then putting onto it is going to be less friction, more. So we're taking out the friction, increasing authenticity, increasing integrity, and you're just creating a lot more liquidity in a larger marketplace. So, I mean, those are kind of the things that I feel will happen, and we're just looking for someone to step up and address that.
Yeah, and I don't think also, because in Sunny, we haven't talked about a lot of other interesting spaces within this, right? Within the broader fintech, like robotic process automation, and everybody's saying that, this, I think, maybe falling into your bucket, Sunny, of efficiency, right? Saying that, 25% of all the bank's work can be done by machines, and, RPA will enable all that to happen, and some processes are well on their way to becoming, completely automated, and you have all these different technologies now to kind of address this. Why do we need humans to do it? So before we I think, wrap up in the next 5 minutes or so, I want you guys to think about the context of the topic here, emerging markets for 2021. I understand we have a disclaimer that whatever opinions you give are your personal opinions, not of your company. So within that context, if you had money to invest as an investor, angel investor, where would you invest? Give me 3 areas for 2021 that you feel comfortable, excited about to invest, right? See, because when you're investing, you're thinking about what markets will come to fruition in the next 4 to 5 years. Where will this startup be, right? Will it be in the right place? What spaces should I be investing in? And the flip side of that is the entrepreneur is thinking, okay, if I'm building this and I'm taking money and diluting my stake, what area should I go after? Should I go after efficiency? Should I go after customer experience? And fintech is also one of those industries where regulations are high, right? Should I partner with a larger bank and do it as an alliance, or should I go direct and invest myself, right? And kind of take the full risk. Within that context, 1 minute each, Sunny. What are the three areas you would invest your personal money in 2021?
Yeah, I'll go for, I hate to mention companies, but it's like a Snowflake, right? If you look at Snowflake and the whole data space, that's an area that I think has huge growth, huge opportunity, and innovation possibilities. The other one, which we talked about, is in the cybersecurity and fraud space. Similar reasons, the growth, the pain points, and the margins can be significant in that space.
Yep.
Last but not the least, the third would be in ecosystem plays, which would be in mortgage lending and commercial. And in those areas, organizations that are going after end-to-end innovations, creating efficiencies and growth. And the reason I like these three spaces is they're attacking problems that are there and will be there for the foreseeable future. And the markets that these three areas highlight are seemingly almost endless, if you may, and the innovation opportunities are significant. So those are the reasons why I would go after those three areas.
Great, Sunny. I think you have left out payments and challenger banks. I think that those are in the rare mirror now. You're looking forward. Wonderful. Because
so from our standpoint, look, we are a huge believer in this entire concept of embedded finance. And we are seeing early stages where it becomes essentially embedded finance becomes a new operating system for people to build their entire ecosystem around. So think about Facebook built using Libra as the default currency for the entire network that they operate in, and using their payments mechanism and stuff like that, right? These are some very critical applications, and you can enable non-financial services businesses to really offer financial services. So that entire concept is very, very powerful. It explodes finance into areas of non-financial services and can be massive, in our opinion, over time. So that's one area. The second area where we are very passionate about is people who are building infrastructure businesses. There is a lot of plumbing to be built. And you saw the examples of Plaid, for example, that Visa was about to acquire and is having some challenges. But Plaid is a terrific example of companies that are core plumbing of the system. So when entire new ecosystems are being spun off, the first things you need in an ecosystem is the plumbing around that moves data pipes, that move data around and stuff like that, right? So we are very bullish on some of those kinds of businesses. And the third is, we mentioned on the blockchain side and stuff. So people who harness the power of blockchain and distributed ledger to reduce friction, create transparency, and create liquidity in asset classes that are very difficult. So think like one of the things that we passionately believe is the concept of wealth is going to change significantly over the next 5 to 10 years. What we and our forefathers used to consider wealth, which is physical assets, the newer generation is actually going to consider digital assets as the true wealth to own. So you can actually end up owning a fractional, share in Monet's painting, or some high-end car, or some asset classes that generally you wouldn't consider as true, capable of being owned, that level of asset and stuff like that, right? So owning assets in a digital form is going to be a big business in our opinion. So that's another area we'll be keeping our eye on.
Given that I'm in the whole wealth tech space, I would definitely pick that space. And also, Sunny, I think cryptocurrency and all of that is, very intriguing and a lot of opportunities there, especially in the more mature markets there. So with that, I think we'll have to wrap here. We have kind of reached our time limit. FinTech is a topic that can actually take the entire 3 days of the conference. But I think thank you, both of you, Sunny and Vikas. If I have to summarize in, I guess, 3 statements, the most interesting aspects of our discussion so far today, right, has been talking about how business models for startups and entrepreneurs are shifting from asset light to risk bearing models, you will have to think a little bit more from a full stack perspective. You have to think about efficiency and customer experience. You have to think about synthetic fraud. You can look at opportunities within embedded finance and the ecosystem players, as you said, Sunny. So a lot of interesting areas for 2021. And first of all, thank you to the audience for listening to us and participating in TGS 2020. And thank you to you, Sunny and Vikas, for participating in this panel. Thank you. Back
Thank you so much. Pleasure.
Thank you, guys. Really appreciate it.
Thank you, sirs, for the very, very interesting panel discussion here. Thank you very, very much once again. All right.